Hello everyone, today's video is all about pensions, specifically the inheritance tax breaks that are afforded to pensions. So it used to be the case that there was no inheritance tax relief for pensions. Pensions form part of your estate. When you die, it gets added into the rest of the pot. However, since the so-called Pensions Freedom Day of 2015, where there are now a lot more flexible ways to access your pensions, one of the other new measures announced then was an inheritance tax relief for pensions, so that pensions no longer count as being in your estate for IHT and can pass to the next generation tax efficiently. So let's have a look and see exactly how that works. So the rules are different depending on whether or not you die before or after 75. So let's take the first scenario. Let's say you pass away before the age of 75. Now, what happens is you nominate someone to pass your pension pot to, and it doesn't matter whether or not you've started accessing your pot or not. So whatever is left in your pension pot, assuming you're in drawdown, and forget the annuity choice that you may have invested in annuity. Let's assume you're in drawdown now, so you have got a pension pot available, and it passes to your nominated beneficiaries. So, because you've passed away before 75, it passes to them tax-free. So they get their hands on the money absolutely tax-free. Now, there's certain conditions, like you can imagine, something where we'll talk about tax-free. So whoever is distributing the pension pot, so the trustees, the pension trustees, which is just jargon for the people who run the pension, they have to withdraw the funds from your pension after you die, distribute it to your named beneficiaries within 2 years. So they've got 2 years to sort this out, or all of a sudden it becomes taxable. So that's the first thing. So 2 years, got to be distributed, passes down to whoever you want it to go to, tax-free. Now, interestingly enough, and very usefully, when you inherit pensions from someone, that pot doesn't count towards your own lifetime allowance. Now, I've done a separate video on lifetime allowance, but basically this is the amount that you can save within your lifetime before you start crystallizing your pension benefits, above which you get hit for tax, and it's just over £1 million. So as long as you've got £1 million in the pot and no more, you're not going to get hit for some extra tax. That's what the lifetime allowance is. But let's assume that you're on 800 grand. So you say, well, I've got a reasonable amount of headroom, 800,000 in my pension pot. I haven't started taking it yet. But all of a sudden you inherit £400,000 from Uncle Bulgaria's pension pot. He leaves you 400 grand. You think, oh my God, hang on, when we add that 400 into my 800, I'm going to bust the limit. It's going to take me to 1.2 million. Well, no, it doesn't, because the rules say that whatever you inherit from Great Uncle Bulgaria does not get added to your own pension pot for the purposes of testing against your own lifetime allowance, even though you may choose to combine it in an existing pension arrangement. It does not affect your own lifetime allowance. So that's a very important point. So, next one. What if you die and you are over 75? So if you die and you're over 75, again, the pension pot does not form part of your estate on which inheritance tax is paid, but there are rules about how it can be passed on to someone else, and there are tax implications this time, unlike if you die with a pension pot intact before the age of 75. So let's say you die over the age of 75, and let's say you pass on a pot. Just take that example. Let's say it's £400,000, and you pass that on to an individual, and the individual says, "Thank you very much. I'm going to take that as a lump sum." That's added to their income at their marginal rate. So let's say someone is a 40% taxpayer. They are paying. They've got a salary. They earn £75,000. They're paying right in the middle of the 40% rate. All of a sudden, they inherit a pension fund worth a few hundred grand, that literally gets taxed straight away in that year of receipt if they take it as a lump sum. So a big chunk of that will actually be at 45%, because 45% kicks in on income over 150,000. So they started off with 75, all of a sudden they got this extra 400. Their earnings for that year, 475, and most of it will be taxed at 45%. So that's what happens when you inherit a pension pot from someone who dies over the age of 75. Lump sum just gets added to your income in the year that you take it as a lump sum. However, you may not choose to take it as a lump sum. You may choose instead to invest it and take it as an income. So, what if you invest it yourself as flexible drawdown and then decide to take that as an income? Well, then it's subject to income tax at that point. So income tax on the earnings. When you take it out, you drip feed it out the pension, you'll pay tax on that as if it was your own pension to begin with, exactly the same way. So you take a lump sum, you're taxed on the whole lot on your highest marginal rate, or you inherit it, you invest it again in a pension of your own, and then just take an income as and when in the future, but you only pay tax on that income, not on the whole fund. So that's the distinction between inheriting a pension pot for someone who dies before or after 75 years of age. Now, one important thing is when it comes to nominating beneficiaries, so you need to look at this from both sides, both from the person who's receiving the inheritance, great, because you've received it, particularly if you received it for someone who's passed away before the age of 75. But what about from the point of view of the person who is ultimately the deceased, who is preparing their will and what have you, their wishes, and deciding who to leave the pension pot to? So if you are that individual and you're deciding who to nominate to receive your pension fund, crucially, it cannot be a legally binding arrangement. Now that's crucial. If there is a legally binding arrangement for when you die, your pot to go to such and such, that negates the tax-free IHT status. And all of a sudden, inheritance tax is in play. So you can't have a legally binding obligation that when you go, your pot that's left, if there's any, will be transferred to anyone specific. However, practically how this works in the industry is that everybody will nominate somebody on a form when you've got a pension. Who would you like to be your beneficiary in the event of your death? And you just put in who you'd like it to be. But technically that is legally non-binding. Now, the pension trustees who run the pension scheme could turn around and say, forget that, we're not going to pass it on to Mr. X, we're going to pass it on to Mr. Y. It's at their discretion. Now, in reality, what happens is they don't do that. They always will proceed with your letter of wishes with the person that you've nominated on your form, like 99 out of 100 times. But that's just the way that the rules are written, that there cannot be this binding legal obligation. So yes, 99 out of 100 or 999 times out of 1,000, it will end up to the person that you want it to go to, but technically there is no legal obligation for the pension fund to pay it to that person. But like I said, they always go along with your letters of wishes. That's just how the law is written, that there cannot be a binding obligation to pass on to Mr. or Mrs. X. So just an overview there on IHT and pensions. So passing on your pension pot to the next generation. If you should pass away, if you die with a pension pot intact, that can be passed down to the next generation. And it can be to anybody. It doesn't have to be to your own kids. It can be to anybody. You nominate who you like on your pension forms as to who will receive your pension pot that's still there in the event of your death. And like I said, better for the recipient if you pass away before you're 75, but obviously you as the donor, as it were, obviously wouldn't want that. You want to live as long as possible. So if you go after 75, yes, there is some tax to pay for the recipients. But the point is, inheritance tax is saved regardless. It's the tax on, the income and what happens to it once it's passed on. But strictly speaking, it does not form part of your estate for IHT, unless, like I said, there is that binding obligation, which there never is, because that's how the paperwork is crafted as an industry with millions of people doing this, so it's they've got the paperwork right by now. But it's an interesting point just to bear in mind if you were thinking about having some sort of something extra other than what's on your pension paperwork, some sort of side agreement that's a codicil to your will perhaps, or some legal document that says this person will receive this from my pension. Be very careful, because legally binding agreements nullify the whole inheritance tax-free status of pensions. All right, so if you like this video, please do subscribe right about there, and as always, I'll see you soon.